now. 안녕하세요. 글로벌 시장에서 통하는 투자법을 알려드리는 뉴욕 나우 한국경제신문 강영현입니다. 오늘은 더그페타 Bca리서치 수석 미국 투자 전략가와 함께 미국 시장에 대한 이야기 해봤습니다. 시장 변동성이 계속 이어지고 있는데요. 이 같은 불안정성이 언제까지 이어질지, 그리고 앞으로 시장 어떻게 흘러갈 것이라고 보는지, 이런 상황에서 투자자들은 어떻게 대응하면 좋을지에 대해서까지 이야기 나눠보겠습니다. My first question about stock market. Market volatility has been severe this year. How long do you think this volatility will continue?
I think that the volatility will continue sporadically, so off and on with spikes throughout the whole year. Indeed, I think it'll go on sporadically throughout the Fed's entire rate hiking campaign, the entire period of time over which the Fed is hiking rates. And the reason for that is the sort of inflation that we are seeing now, that is what is impelling the Fed to embark on this rate hiking campaign, is larger than any inflation that nearly every investor who's in the marketplace now has ever seen. Because we haven't seen this sort of inflation for over 40 years. And if you have to be, say, at least 30 years old to have had significant decision-making responsibility as a professional investor, that means the only people who have actually seen this with their own eyes are now over 70. And there aren't all that many people that are over 70 in this business. So this is something new that the market has to deal with. And therefore, I think it's reasonable to expect that it will be jumpy and the prices are going to make bigger moves. We're going to have larger gyrations than we otherwise would. And I think that's what's really driven volatility to this point this year. And again, I think it'll continue throughout the Fed's entire rate hiking campaign, off and on. I think it'll settle down and then there'll be another burst and it'll slowly come down. And after a while, there'll be another burst. I think we can expect to see that throughout the entire rate hiking campaign. Because remember, this is also very new territory for the people at the Fed making decisions now. We've had effectively zero interest rate policy since the beginning of 2008. And we have not really normalized interest rates. The Fed got interest rates up to 2.5%, but then quickly backed away. They got there at the end of 2018. But then by the summer of 2019, the Fed was cutting rates again. So this is new territory for the Fed as well. And it's all starting from unprecedentedly low rates. We never had zero interest rate policy before. So all those things together, the newness for the Fed, the newness for investors trying to navigate this inflation backdrop, and the uncertainty of Fed communications around it, I do think all of those things together are going to keep volatility high beyond this year.
Can there be a bigger correction within this year?
So, I just offered the view that we're going to continue to see volatility be elevated throughout this year, and again, perhaps even beyond this year. But I think that we should expect the stock market corrections to get smaller over time if they are created by the same issue. Because I like to think of markets as having sort of a short attention span. They can't concentrate on any one thing for too long. So that as investors get a feel for the Fed's communications, as the FOMC members and the Fed governors get a better feel for how to communicate, I would expect that the uncertainty over the Fed's path is going to shrink. And that therefore the reactions to any individual CPI report or any individual FOMC meeting and the decision that follows, or even the speeches that the various voters make, I would expect that you'd see the moves in the stock market diminish across the year. Now, of course, something totally new like Russia and Ukraine or any other geopolitical incident, that could lead to a bigger correction. But as far as corrections that are driven by we expect is going to be the continuing source of volatility, inflation, and the Fed's moves to try to combat it, I would expect that those corrections are going to shrink. So we'll have rolling corrections throughout the year, perhaps, but I would expect that they get smaller as the year goes by.
In this case, how should investors behave? Other experts advise that it is time to invest in financial and energy stocks instead of tech?
So we at BCA are very much in line with the idea of energy and financials will be good places to be this year. Our house view is that we are overweight those sectors. There's some discussion within the firm as to whether or not we should expect that tech stocks will underperform this year or whether they'll simply perform in line with the overall index. But no one at BCA is arguing for overweighting tech stocks right now. And I think, we discussed, the last time we spoke, we discussed interest rates and tech stocks. But beyond the interest rate issue, tech stocks, the biggest ones, they confront a pretty challenging regulatory backdrop right now, both within the United States and outside of the United States. And the stocks that account for the largest share of S&P 500 technology market cap, the biggest stocks, they're almost under siege from regulators, here and again, outside of the United States. So there are plenty of reasons, I think, to be concerned about the biggest tech stocks' ability to continue to grow earnings the way they have to this point. Of course, there's a law of large numbers, right? The bigger that base of earnings gets, the more difficult it gets to grow it at 20, 25, 30%. Yes, at BCA, we do want to overweight energy and financials right now. Don't want to overweight tech, although I'm more in the equal weight camp within BCA than underweighting tech. But I think more broadly, if we look beyond sectors, what should investors do? Well, in that elevated volatility environment that we've discussed, one thing I think investors can do is they can try to shorten their holding periods. Hold any individual stock, any individual position for a shorter period of time than they otherwise would to try to navigate the big swings, the big moves up and the moves down, and the moves up and the moves down. So that when we have a meaningful correction or when stocks have gone down by a meaningful amount, perhaps you add the positions. And then as they recover, perhaps you get rid of that added position. So I do think, in addition to having shorter holding periods, investors should be holding more cash than they otherwise would right now so that they are able to be opportunistic and to take advantage of these swings. One other way they can do it is, to the extent that investors' mandates will allow them to invest in options. When you think that volatility is really high and not likely to continue, when you think that we've reached a short-term peak in volatility, one thing an investor can do is write put options, effectively selling someone else insurance on further declines. And if you think that the declines have gone far enough and the volatility is really high, then that might be a good time to sell insurance, and vice versa when volatility settles down. So one thing we are watching for that, my team at BCA, we're just looking at the VIX, which is the measure of implied volatility on S&P 500 index options. And when it's in the 30s, seems to us like, all right, that might be a good time to be using these selling volatility strategies or selling insurance. And then when volatility settles into the low 20s or the high teens, perhaps that's a good time to close out those selling insurance positions. So I think it's a combination of things. Shorter holding period and considering actually investing directly in volatility via index options.
Shifting gears, price indicators will be released on the 10th of next month, and the FOMC meeting will be held the following week. Do you think it is possible to raise interest rate by more than 50 basis points according to price indicators?
Of course, it's possible, but we think that it would be really, really unlikely that the Fed would hike by more than 50 basis points or by more than 0.5 of a percentage point. As a matter of fact, our own bond strategy team thinks it is more likely that the Fed will hike by 25 basis points at the March meeting than it will by 50. Now, it's absolutely not out of the realm of possibility that we could get 50 basis points. Certainly, several voters have been talking about 50 basis points in March. So we do think the decision comes down to 25 or 50 basis points. We lean to that 25 basis point side because at BCA, we do think inflation pressures have begun to ease, and that therefore we are going to see the price indicator, the year over year consumer price index coming out on the 10th, We expect you're going to see that decline across this year. Now, will that February number be lower than January 7.5%? I don't know. But we do expect over time across the year, we are going to see a steady decline. And if that's the case, a move to hike rates by, say, 75 basis points at the March meeting, we think that the Fed would see that as unnecessarily unsettling financial markets and unsettling, not just investors, but all participants in the economy, consumers and businesses. So that, again, we think it's a choice between 25 and 50. We think 25 is more likely than 50. And we really do think something like 75 or above simply isn't going to happen at the next meeting, regardless of what that February CPI report might tell us.
James Broad argued that preemptive action is important. He said Fed has to raise 100 basis points before July. What do you think about this?
It's certainly within the realm of possibility, and we can get to 100 basis points by that July meeting without needing 75 or more in March. The Fed meets 8 times a year, so it works out to roughly every 6 weeks. We're going to have the meeting then in late May. There's going to be one, in late March. There's going to be one in early May. Then there are going to be meetings in June and July. So that's 4 meetings between now and then. If the Fed were to hike 25 basis points a meeting, that would get to St. Louis President Bullard's 100 basis points, the 100 basis points that he says he'd like to have in his pocket by July. And I think that's reasonable. Now, he tends to be a bit of an outlier on the FOMC. He makes some pretty bold, splashy statements, but I don't think within the FOMC there's a lot of disagreement around the notion that 1 percentage point over the next 4 meetings. I think that would go down pretty easily within the Fed. I think it would go down pretty easily with financial markets, which have really pulled forward their expectations for how soon the Fed is going to hike and the pace of its rate hikes. That 100 basis points by July would not surprise markets. So it's not something that would be disruptive. I don't think it's not something that would be new information that would call for a repricing of either stocks or bond yields.
Someone point out the Fed has fallen far behind the curve on inflation.
I think that's fair. I think it has fallen behind the curve a little bit. It's certainly the 7.2% year over year consumer price index in December and the 7.5% in January, that took the Fed by surprise, given its statements across 2021 and how it had been talking about transitory inflation. Whatever transitory actually means, I think we all took it to mean that, look, the pandemic has caused some disruptions in many segments of the economy, and that has led to higher prices. And then, of course, we've got these supply chain issues. As you have outbreaks of COVID around the world, you have to shut production lines. Ports aren't operating at the same capacity as people are out of work. And that led to what were perceived to be temporary upward price pressures. Well, it spread beyond that. And the Fed sought average inflation of around 2%. Well, when we get into the 7%, the high 6s and the 7s, that averages with outright deflation. Inflation has gotten well beyond the Fed's goals for it in the short term. So yes, it would seem that it's fallen behind the curve, and therefore Fed officials have spoken much more hawkishly, and they surely have pulled forward their own timetable for hiking rates. However, I don't think they've gotten so far behind the curve that we are looking at a spiral like we witnessed in the 70s in the United States, really around the entire world. For that, long-term inflation expectations are really important. People change their behavior, whether they are employees, businesses, consumers, or investors, based on their long-term inflation expectations. And we've seen this in Japan with the with the deflation mindset that has taken hold there, when people change their behavior, when they expect prices are going to continually fall. And that has the effect of reinforcing those price declines. So that if employees believe that inflation is going to be 7%, the numbers that we've been seeing, if they think it's going to be 7% over the next 5 to 10 years, they are going to demand wage increases that keep pace with that, whether they're represented by unions or not. We haven't seen anything even remotely like that. Businesses, if they believe that we're going to have very, very high inflation over, say, 5 to 10 years, will absolutely insist on price hikes from whomever their customers are, right? Wherever they sell, wherever they are in the chain. Then you would have consumers, if they believed inflation is going to be really, really high, attempting to spend their dollars as fast as they possibly could to get as much with them while they are losing purchasing power. We are not seeing that. And when that happens, that increases demand in the short term and again, keeps feeding this loop. And then finally, if investors believe that inflation is going to be much higher in the longer term, they're going to demand greater compensation from borrowers. And therefore, interest rates would have to rise a lot to compensate investors for those expected inflation increases. But the 10-year Treasury yield isn't even 2%. So we don't have those concerns filtering through right now. Whether you just look at 10 and 30-year Treasury yields, whether you look at more sophisticated inflation expectations measures within markets, or if you look at the University of Michigan Consumer Sentiment Survey, where consumers are asked what they expect inflation is going to be in 1 year and what they expect it's going to be in 5 years. And when they get asked, is this a good time to buy a car or not? And when it comes to prices, respondents can say, yes, it's a good time to buy a car because prices are high and they're not going down. They won't go down. Or they can say, no, it's a bad time to buy a car because prices are too high. Right now, 5% of Michigan respondents are saying it's a good time to buy a car because prices are high and they won't go down. 54% are saying it's a bad time to buy because prices are too high. That 49 percentage point spread is larger than it has ever been in the history of that University of Michigan series. So consumers have not changed their behavior to say, oh boy, I'd better get while the getting is good, unload this wheelbarrow of Deutsche Marks, if we can go back to the 1920s, before I need 2 wheelbarrows in the afternoon to buy whatever good it is.
In the last interview, you predict that inflation would remain 3 to 4% until the end of this year. It is lower than it is now, but it is very high number from a historical point of view. What is the best asset allocation strategy during inflation era?
So just to clarify my own inflation expectations, now, when I said 3 to 4%, I was saying 3 as the big figure in front of the percentage point, anywhere from 3 to 4 as the big figure. So anywhere from 3% to 4.9%. I realize that's a really wide gap, but the point for us at BCA isn't to try to predict where inflation is going to be to the 0.1%. It's just that if we get somewhere in the 3s or the 4s, so anything from 3 up to 4.9, that would represent a decline from where we are now. And we think that's the most important point. If we do start to see these inflation readings easing, that would take pressure off of the Fed to contemplate doing things like hiking by 75 basis points in this first meeting, or really aggressively trying to get rates higher to slow the economy, really aggressively attempting to slow the economy. If inflation is on a path to decline and on a path that everyone in the economy is less worried about it, then the Fed can progress at a deliberate pace. And what I think is really important, getting into how investors should position themselves, as long as the Fed is removing accommodation at a deliberate pace, what we will have in 2022 is the Fed using monetary policy to reduce the level of stimulus it is providing to the economy and not crossing into the territory where the Fed is using monetary policy to actively hold down the economy, to actively slow it. if the equilibrium Fed funds rate, the funds rate that neither encourages activity, so neither provides stimulus nor discourages activity, tries to restrain the economy, is somewhere in the neighborhood of 2.5% or above, which is what we think at BCA and which is what the FOMC indicated the last time it had the dots, the summary of economic projections, after its December meeting. If you have to get to 2.5%, above 2.5%, to actually be restraining the economy, it's really unlikely we're going to get there in 2022. Right? It is very unlikely that we would go from basically 1/8 of a percentage point for the Fed funds rate right now, that is halfway between 0 and 1/4%, or 12.5 basis points, because right now the target Fed funds rate is a range between 0 and 25 basis points. To get from 12.5 basis points to 250, that is 237.5 basis points of hikes. The markets aren't calling for that. They had been around 175. It looks like they've revised down to about 150. Well, if we get 150, even if we get 175 this year, that would get us effectively to 1 7/8%. That's not 2.5. And additionally, monetary policy works with a lag that economists think it's anywhere from 6 to 12 months. So that even if we have 1 7/8 at the end of this year, let's round up and call it 2%. Even if we have 2% on the Fed funds rate at the end of this year, it won't start to filter through the economy fully until either June 30th, 2023 or December 31st, 2023. So with all that as a backdrop, we do not think that the Fed is going to have the Fed funds rate at a level that is going to slow the economy in 2022. We think it is simply going to be reducing the amount of stimulus it's providing to the economy. If that's the case, we still like equities. We still think an investor in all asset classes, a multi-asset investor, should be overweight equities, and that investor should be underweight treasuries, and indeed should be underweight developed world sovereigns all across the world. So we still embrace taking risk in portfolios, and then things like real property, things like real assets, they do tend to hold their value better when you do have an inflationary environment. So on real property, real estate, we prefer apartments where the leases reset every year, as opposed to office buildings or retail space where the leases might run for 15 years. So they tend to be much longer duration buildings, whereas apartments are much shorter duration buildings and therefore are better protected from the rising interest rates that we would expect to occur alongside high inflation.
Okay, then, shifting the gears. What do you think about the tension between Russia and Ukraine? Can you talk a little bit about how those fit into the US stock market?
Sure. So our geopolitical team is of the view that it isn't over in Ukraine. And even though financial markets breathed a sigh of relief when they came back, when we came back to work after the President's Day holiday in the States, we don't think it's over. We don't think Russia will be content just to recognize those breakaway republics, that there will be more. But that's not necessarily terrible for the United States financial markets, especially relative to other financial markets around the world. For one thing, if the tensions or if the actual clash gets worse in Ukraine, then presumably that would feed risk-off behavior that would make investors more risk-averse around the world, and therefore the most defensive currencies in the world, the Swiss franc, the Japanese yen, and the US dollar, would be expected to appreciate against other currencies. Additionally, you would expect that investors around the world would want to own the world's risk-free asset, US Treasury securities, so that, at the very least, US equities would benefit on a common currency basis from the US dollar appreciating against other currencies, and that you would expect rates would fall in the United States if you have this general risk-off move. Finally, the US is now one of the world's largest oil producers. And one thing that you would expect would occur if the clashes intensify is that oil prices would rise because Russia is a big oil producer. And it's entirely possible that, so those crude oil prices, also natural gas, much of continental Europe, much of Western Europe depends on Russia for natural gas. If things would really come to a head and Russia would cut off natural gas supplies to Western Europe in response to the sanctions that would presumably follow, then you'd see natural gas prices rise. The easiest place for continental Europe to get natural gas would be liquefied natural gas from the United States. So I would think in a relative sense, the United States would benefit. United States financial markets would benefit if things get much worse there. Although in an absolute sense, it would probably be bad for markets everywhere around the world, at least temporarily.
How about oil prices? What's your forecast?
So again, we would expect, at least in the short term, they would rise if we have a worsening situation in Ukraine. And then, on the other hand, if the Ukrainian situation gets settled fairly quickly, then the worries that have helped drive West Texas Intermediate and Brent crude into the low and mid 90s per barrel, well, you would expect some of that would come out and we'd go into the 80s, wherever the fundamentals would put crude prices now. Because definitely our team believes that crude prices in the 90s, that's a function of the market discounting things getting worse in Ukraine. And if the Ukraine issues were to be settled, they think prices should be in the low to mid 80s.
Someone expects the oil price will be $150 if we got a big spike in prices. Could that be actually a risk to growth? Should we be concerned about that?
Well, most certainly $150 a barrel would be a tremendous blow to the global economy. But we would be happy to take the other side of that. We will, our commodity team would be happy to sell $150 crude futures because we just don't think that that's going to happen. Certainly, it does illustrate, look, higher crude oil prices, higher energy prices more generally act as a tax on activity around the world, and it would slow global growth. But we do think this will, one way or another, we think this will end fairly soon. And one lever the United States could pull would be to bring Iranian oil back onto world markets. And there are, Washington, D.C. is now negotiating with Tehran, or there are multilateral talks of reviving the pact that the Obama administration reached with Iran that allowed Iranian supply to be in the global marketplace. And that is something that could help alleviate pressure if the tensions with Russia and the rest of the world were to get worse.
Okay, thank you for your answering my questions. Thank you, Doug.
Thank you.